Move on then and focus in on the NBFC sector. And the RBI yesterday announced a special liquidity scheme for NBFCs, a breather of sorts for the HFCs and NBFCs, eliminating risk to the financial sector. Let's understand these reforms in greater detail. My colleague Poonam standing by with all the details. Poonam.
Well, the Government of India has approved a liquidity scheme for NBFCs, HFCs as well as the MFIs in order to help their liquidity position so as to avoid any potential risk to the entire financial system. Under the scheme, SBI Capital Markets, which is a subsidiary of State Bank of India, would be managing a special purpose vehicle. In fact, the government states that the SPV will be purchasing the short-term papers from the eligible NBFCs, HFCs, who in turn would be utilizing the proceeds under the scheme solely in order to extinguish their existing liabilities. These instruments, of course, would be in the form of CPs, NCDs with a residual maturity of not more than 3 months and which would be investment grade. Well, the facility will not be available for any paper issued after 30th of September 2020, and the SPV would cease to make any purchases after 30th September 2020 and would be recovering dues by 31st of December. In fact, what does it mean for the system? Well, nearly around 50 to 60,000 crores of entire liabilities or debt instruments are set for maturity between July to September by various NBFCs, and mostly these smaller as well as mid-sized NBFCs would be availing this facility because they are in dire need of better liquidity profile, and hence this entire scheme would be beneficial primarily for smaller as well as the mid-sized NBFCs, as large NBFCs.
Much, Poonam, for giving us those details. Let's talk about some of those special liquidity facilities and those guidelines that have been announced with Rajesh Sharma, Managing Director, Capri Global, now joining in on the show. Thank you so much for taking time out. To begin with, what is your view on the recent guidelines that have been issued by the Reserve Bank? Do you think that the creation of this SPV is going to help in providing the necessary support to the sector, at least a positive step in the right direction?
So it is a part of that larger Atmanirbhar plan where the government as well as RBI has announced a scheme including TLTRO 1, 2 and the special liquidity scheme. So this special liquidity scheme will cater the needs of few NBFC housing finance and maybe microfinance where they have a slight mismatch and short-term pressure. So basically, it is done with the aim so that there is no risk in the financial sector, there is no default happens by some of the companies who are in the mid of raising money. They have yet to materialize their sanctions and limits, and meanwhile, the repayments are falling due. So they can avail this window of 3 months and utilize that money to extinguish the existing liabilities of the repayment. Basically, that another 3 months a microfinance or housing finance or NBFC will get to mobilize the funds. These repayment of the securities issued by the special liquidity scheme by the SBI subsidiary setup trust will be only for a period of 3 months. So it is a direct way to extend their repayment obligation by 3 months, and within that period, they can look for a long-term funding from banks and institutions meanwhile. So this is a scheme given which will help them, whosoever in their stress, to get more time and do not default.
Fair enough. Do you think that this move, though, will address the issue of the higher funding costs for the sector? Do you think that borrowing costs could come down as the funding pressure will ease?
I think only this is meeting the mismatch currently where somebody needed more time, so this is giving only 3 months extension. I think this window itself will not help in reducing the cost because you are getting money only for 3 months, while housing finance company require a long-term money. The NBFC also look for a medium-term money, and microfinance maybe for 4 or 5 years. But this money is for 3 months. So 3 months, even somebody get the lower cost. I think that the whole purpose of the scheme is not the cost reduction, but the whole purpose is that somebody who is having a mismatch and require immediate money, so they will not default. They will take the money from this scheme and repay to their existing lender, and they get another 3 months to repay this liability. Whatever they borrow under special liquidity scheme, also at the moment has been given 3 months window only. This money is available to extend your repayment by 3 months by not falling in any default kind of a situation.
All right, thanks very much for sharing with us your outlooks. Certainly a step in the right direction. On that note, then, we'll slip into a quick break right here on the show. Stay with us. Lots more lined up when we return.